Most investors are using AI completely wrong. They're using it like a chatbot. They're asking it stuff like, is Tesla a good stock? They're asking it to write research notes. That is not where the edge is. There are actually 7 specific ways AI creates a real investing edge, and I'm about to walk you through every single one of them. By the end of this video, you're going to know exactly what separates investors who are actually getting alpha with AI versus the ones who are just using AI like a chatbot. So let's get straight into it. Okay, first thing first is the frame, and this is very important. Most teams will use AI, but that's not where the edge is anymore. Everyone is going to have access to the same tools. The edge comes from what AI does to your workflow. Specifically, 3 things. Number one, does it give you a faster time to thesis? How quickly can you go from I've never heard of this company to I have a view? Number two is better signal quality. So, are you actually catching on the things that other people miss? Are you filtering out the noise better? And number three is more consistent decisions. Are you making the same quality decision on your 50th ideas as your first? And here's the key line at the very bottom. If AI does not change these, it is just software. It's not giving you an edge, it's just a shiny toy. Now, let me show you the 7 specific ways AI actually moves the needle in your portfolio. Edge number one is where most investors should start, and almost nobody does this right. It's called coverage advantage. And here's the idea: AI expands your research surface area without expanding your headcount. What does that mean? You can now track more competitors, more themes, more second order effects, more data points and channels. And if you really think about it, before AI, if you wanted to monitor 200 plus companies across, say, a given sector, you needed a whole team. And now with AI, if you have the right systems, you can set up the right monitoring system that surface what matters at any given point in time automatically through these sort of AI agents. The edge is simply seeing more earlier. And that's it. You don't need AI to be smarter than you. You need it to help you see more than your competition. But coverage isn't enough. You also need the speed, and that's edge number two: time to understanding. And this is where AI gets really powerful. The idea is this: compress the first pass from multiple hours or even multiple days to just a few minutes. And when you're looking at a new company, there are really 4 things you want to understand: what the business is, anything that's changed recently, what's being debated in the market, and what matters for your thesis. In the past, if you've done any work in equities or any work in investing, getting these 4 things took a full day or multiple different days, right? Reading the 10K, reading the earnings transcripts, checking analyst notes, pulling data. Now you can get 80% of that understanding, maybe 95% of that understanding in just about 15 minutes and the right prompts and the right prompt structure. Now, before I get to the next 5 edges, which is where it gets really interesting, I'm going to need you to hit the subscribe button if you are interested in getting a step ahead in these AI tools, specifically for investing and finance workflows. I break these down every single week, and the next video could be the one that changes the game on how you do your work. Anyways, let's continue. Edge number 3 is information synthesis. And this is one of my favorites because this is where AI is genuinely better than humans. Here's a problem. As an investor, you're drowning in text: filings, transcripts, news, your own notes, brokerage research. The question is, how do you turn that messy pile of data of these notes into decision-ready inputs? And this is what AI does. You feed it everything and you ask it to extract the key deltas, basically what changed, the contradictions, what sources disagree, the open questions, what is still resolved. That is the synthesis. It's taking 50, 100, 500 pages of noise and turning it into one single page brief that tells you what matters. So information synthesis, edge number 3. Now, edge number 4, and I can't emphasize this enough, is where most investors lose money. It's called thesis monitoring. Here's the insight. Most losses don't come from a lack of data. They come from late updates. You had the data, you didn't process it fast enough, the narrative shifted, the KPIs drifted, something changed, and you were the last person to update your view. AI fixes this by giving you 3 things. It gives you the change detection, automatic alerts when something moves. It gives you narrative shift tracking. It gives you KPI drift monitoring. Are the numbers trending the way your thesis is predicting? Avoid being the last person to update your view. Edge number 5 for AI is alternative data. So this one's a little bit more advanced, but this is where serious edge lives. The idea is this: you can measure reality before it actually hits the model. And what does that mean? You're using non-traditional data sources to get earlier reads on what's actually happening in the world. And the reason why you're able to do this is AI tools like ChatGPT, like Claude, like Google Gemini have native Python capabilities embedded within their models. So you are now effectively a data scientist, a quant type of research without having to know how to code at all. This unlocks an entire universe of number crunching, of web scraping, of data science for all sorts of fundamental investors. Edge number 6 is signal discovery. And this is where AI starts to do things that humans genuinely cannot. Here's the frame. AI can find patterns that humans miss. What kind of patterns? I'm sure you're asking. Three things: nonlinear relationships, multivariable interactions, and regime-dependent behaviors. Humans are absolutely terrible at this. We think in linear, one variable terms. AI can process thousands of combinations and surface what's actually predictive. And finally, number 7. This one is turning all of that research, all of that information into actual better portfolio decisions. It's called portfolio construction. You can make better decisions conditional on forecasts using AI capabilities. Here's the thing: you can have the best stock picks in the world, but if your sizing is wrong, if your exposures are wrong, if your exposure management is wrong or sloppy and you don't account for volatility, you are still going to underperform. AI can help you systematically with less bias do a couple things. It can help you have better volatility aware sizing. It can help you with drawdown control. It can help you with your exposure budget. It can help you with your regime logic. So different rules for different market environments. The goal is not a prettier forecast. The goal is a better portfolio, as we see here. And that brings us to the synthesis slide. So AI should reduce friction between research and the position. Faster scenario checks, cleaner sizing rules, consistent decision logs, verification steps. And here's the bottom line: the edge is repeatability, not a one-off good call. Anyone can get lucky once. The question is, can you do it consistently? Can you build a process that compounds? This is what AI enables if you use it correctly. So here's how I want you to pressure test whatever AI tools you're using. Ask yourself two questions. Does it shorten time to thesis to update? And does it improve signal quality and portfolio decisions? If the answer is yes to both of these, you're using AI correctly to scale up your investment research and take full advantage of these sort of AI tools and capabilities.